Welcome to Shark Cap Table Fast, the 1-minute deal maker for sellers and buyers of equity that helps you keep your arms and legs. Now, we're going to go through what it's like to buy shares that have been offered to you as opposed to structuring a company to sell its shares. Go up to the section A and select from drop down the buy shares. You can leave it at investor. I don't like to call myself a shark, so I'll just call myself an investor. And it's for purposes of clarity, I would suggest that you hide all the help. For example, if you show the help, there's a lot more information coming in areas like this, but it also tends to clutter, and I'd like you to get the point what's going on here without the clutter, but it is useful, so you eventually should read it. But right now, hide all the help. Okay. Now you're going to see some numbers in here, and the reason the numbers are in here already is that we have numbers down here, and they have been placed pretty much up there, but there's a few things I'd like to go over. So, you've been offered shares in Whizbang Corporation, a privately owned company seeking expansion capital. Good. Shark Cap Table Fast is correctly set up to do a buy shares analysis. Please obtain a copy of the selling brochure and dig into it. For example, we're going to enter deal data from a selling brochure. We've already done this for you. Total units offered, 50. $10,000 unit price, 10,000 shares per unit. The unit share price is $1. There are 10,000 attached warrants per unit, and the exercise price is $1. Let's make that $1.50. There we go. Now, it's hard to get these next two numbers, and we'll move these guys off to the side so we're not looking at those. These, by the way, are pop-up help. There's a lot of pop-up help throughout this model. So the first two is the amount of cash invested by the Whizbang founders and the additional value, which might be markets, sales tests, contracts, people, beta test revenues, a whole slew of things which you already know about from this section right here. Remember all of this? Same thing applies to the company selling, except this time you have to determine what it is from a paucity of information. So let's say it's $100,000 cash, $1 million of additional value, so that gives them a total Whizbang valuation of $1.1 million. The selling brochure says they have 1 million shares outstanding. They may not be clear about the existing options, warrants, and convertibles. They never are. So you have to ask a very pointed question. How many options, warrants, and convertibles? And oh, by the way, the guy who's selling this, how much of an option is he getting, or how many shares is he getting from the sale of the shares? You'll find that their commissions are usually about 10%. So if they sell 1 million shares, there's another 100,000 shares coming out of your pocket because of the commissions. They'll tell you that they're going to sell in year 2 or 3 or 4, whatever, so put it in, and they'll tell you what they think the price could be. So here's the total raised from the 50 units, and here's the amount needed for the warrant exercise at year 5. Now, sometimes warrants get exercised in year 2 or 3 or 4. We've made this simple. We simply say that whatever the warrant is, it's long enough to extend beyond the sale or exit year, and hence you're going to exit the warrant, you're going to exercise the warrants just prior to the exit of the company so that you'll be fully vested. Okay, so here is the offering summary, and these are the summaries of things like the exit value with exercise warrants, etc. So you can read down here. Now let's go back up and see what's actually happened. Okay, so you can remember these numbers. These automatically come in, and these spin buttons here aren't going to help you because they're locked. And there's the valuation, and here's the shares outstanding. Again, this isn't going to do any good, but this one will. Here's the number from below. You need to make it approximately equal right here by spinning the number, and there it is. Sometimes it won't be exact. Now, let's put in for the units investment. You can see that we've already done it. So it has to, the blue has to equal the red, the blue has to equal the red. And now here we need to do something. Right here in this caption it says that the unit offering price per share is $1. So we need to make this number here, which is the unit offering price that's going to actually calculate, equal to $1 by increasing the pre-money value. Now, in this particular case, let's see what we've done. The fully diluted ownership of the company includes 20% Wiz options. Those are the existing. Wiz founders have 40%, and the units own 40%. The investment multiple is stout for the Wiz founders and 3.2 for the units. The internal rate of return for the Wiz founders is 109%, and the units have a little over 40%. And the Wiz founders control the deal. And that's based on the year 5. Now, we really need to come back down to year 2, and you'll see that the internal rate of return goes up. On the surface, this doesn't look like too bad a deal. The difference between what you think the company's worth and what the pre-money value is not too much. This generally should be less than this, but we are the ones that are valuing the company, so we're going to be a little bit low. So this is not too bad. I'd like to see it down into this range, something like that, and that would give us a much better internal rate of return. But watch what happens when that internal rate of return gets delayed a little bit. See, maybe year 4 it happens as opposed to year 2. And what happens if we get less than 10? Maybe we only get 6 million. Well, now it gets down to a ho-hum rate of return after 4 years. It gets worse after 5. The investment multiple still stays the same. So when you put the pre-money value below or equal to the founder valuation, you get a more realistic deal. It can save you a lot of money if you look at this carefully. So many of the deals do not give you any upside potential. For example, are you really going to see the exit value, and what about the risks ahead? Haven't the founders and the option holders sucked too much out of the deal for hardly any cash? Isn't the pre-money value that drives share pricing way out of line with the founders' valuation? And aren't you paying too much for too little? Is there any juice left in the deal for you? Thanks again for watching this tutorial on Shark Cap Table Fast, where we're going to be doing an analysis of buying shares. Shark Cap Table is the 1-minute deal maker for sellers and buyers of equity that helps you keep your arms and legs. Now you know what we mean. If it's a bad deal, stay away. Thanks very much. Bye.